as you're coming in. Welcome to another Community Capital Live, a production of the Main Street Journal, the Neighborhood Economics, the Mindful Marketplace Show, and Impact Alpha. Very grateful to all of you who are jumping on here with us and taking the time out of your day to do this. I know there's lots of options out there for how you could be spending your time, how you could be spending your screen time, as it were. And we're grateful that you chose to spend that with us, and we want to make sure that it's worth your time here. And I think it will be today. We have a great conversation we're going to get to have with Steve Saltzman from the New Hampshire Community Loan Fund. Steve and I were connecting here before we came on mic about his love for my hometown where I live in Asheville, North Carolina, and I'm excited to get to have him share with you all the work he's doing with the New Hampshire Loan Fund, and also talk a little bit about CDFIs and kind of the changes that we're on the lookout for that are currently underway. Do want to make sure we shout out again all of our partners and panel, especially the check out Neighborhood Economics has an upcoming conference that you guys will want to check out. It may be the right fit for you to come to. That is going to be down here in Asheville, North Carolina. So it'd be a great opportunity for you to tie that in with some beautiful mountain scenery, some contributing to a local economy that badly, badly needs it, and a good chance to connect with like-minded folks. Also, the Main Street Journal is the place to go for local and community investing. And definitely check them out, get subscribed to their newsletter, and check out more and more video content that's going to be up and coming, which we can announce later. And also the Mindful Marketplace Show, my show on bizradio.us, as well as Impact Alpha, who is the place to go for all your impact investing news, whether that's local, international, or otherwise. And our panel today is going to be a little light on the panel, but I think that's good. We're going to get to dig in a little further, It's just myself here, and of course, Michael Schuman, who you know as the editor-in-chief of the Main Street Journal, but also the author of several books on really the 101 books on local investing. There's a bunch of them out there. Local Dollars, Local Cents was the first one I read. And his most recent, which I think you should start with, is called Put Your Money Where Your Life Is. So, Michael, so glad to have you on here today. And we'll get in with you on some questions about the fund. But Steve, yeah, tell us a little bit about the New Hampshire Community Loan Fund. I want to know sort of where this all came from and how it started.
Well, first, thanks for inviting me to be with you. It's a real honor, and it's always fun to be in these sort of conversations. If it's okay, I'd like to tell you the origin story of the New Hampshire Community Loan Fund, if that's okay.
Yeah, absolutely.
Okay, so in 1984, there was a trailer park in Meredith, New Hampshire, 13 families, and the aging owner was going to sell to a hotel developer. And it meant that those 13 families who own their own homes but didn't own the land underneath were basically going to get evicted. And it's one of the great misnomers: mobile homes are anything but mobile. And so a guy named Elliot Berry, whose daughter-in-law is actually sitting next to me, helped organize the 13 residents, 13 homeowners in this trailer park to form a cooperative so they could buy the park. And we sort of formed, we made a $42,000 loan to help these 13 families buy the park as a cooperative. And the investor that we got to help give us the money that we re-lent to the 13 families came from the Sisters of Mercy. So there were a group of nuns invested in the community loan fund to do something not only that we had never done before, that no one in the country had ever done before: organize residents of a trailer park into a cooperative. But it became very successful, and this is one of the oldest co-ops in the state. Elliot helped organize at the same time, working in the legislature, to get what was now called the 60-day notice, where anytime a trailer park goes up for sale, the residents have 60 days to match the offer of the competing buyer. And we could spend hours talking about everything that's sort of surrounding that now, as we're sort of engaged in this fight with private equity funds and whatnot that are really trying to put pressure on all these home buyers. But to make a long story short, since that experience, we've organized 151 resident-owned communities in the state of New Hampshire. 151 co-ops in which the residents have bought the trailer park where their homes were. It's this whole idea that even if you own your own home, if you don't own the land underneath, you're never really secure. And we have found that this has really built multi-generational wealth. About 20 years ago, we spun out a national nonprofit called Rock USA and resident-owned communities, and they have organized about the same number of co-ops around the country as we've organized in New Hampshire. I'll keep going if that's okay. But 20 years ago, we noticed a problem that we're really good at organizing co-ops. About a third of our organization consists of community organizers. But the problem was people who were buying mobile homes were often falling into traps of predatory lending. So we made what I think was the first 30-year fixed rate mortgage for people to buy a mobile home, a manufactured home. And this has become a really big part of our business. And for those of you that are in the home lending business, half of our borrowers have credit scores below a 620. And the performance of these mortgages, our default rate is less than 2%. And it's really, so for us, there's a real policy import to the data of this. And if you think about the way that federal housing policy is, it's really focused around low-income multifamily housing, and it really doesn't understand the asset value of these manufactured housings. If you look at the last 5 years, manufactured housing in New Hampshire has appreciated more than conventional stick-built homes. So we have our first full-time policy person, and we're really trying to work on how do we change GSE policy. Like a lot of other community development lenders, we do other things too. We really have a big focus on regenerative ag. We do a lot of clean energy lending, but our clean energy lending is really focused on low-income communities and community solar. And that's a real important part of our business. We do small business lending, basically to entrepreneurs who can't get access to capital from banks. So I think we share a lot in common with, I think, everybody that's appeared on this show in terms of trying to help people that, how do you ameliorate economic disparities?
I love that. So you mentioned a lower default rate, even though you're working with folks with lower credit scores in general.
Yeah.
Does the cooperative nature of the fund, does that play into, like, is there a line you can draw from A to B there, or is there, like, what do you think contributes to that?
I think there are a couple factors. We do a lot of coaching. And everybody says they do a lot of technical assistance, but last year we did 25,000 hours of technical assistance and coaching, and it probably wasn't enough. Since 2014, we've done over 500,000 hours of coaching. And sometimes it's about right-sizing a loan. Sometimes it's rebuilding credit. A lot of people come to us who don't have credit. So a lot of it is, it's a lot of working, with our borrowers. John Powell, a law professor, at the University of Berkeley Law School, had a great article, years ago about structural racism, and he said you really have to differentiate between who's incomplete and who's incompetent. And I think we have now 20 years of mortgage lending, where we can really figure out, who has the hallmarks of a good borrower, even if everything isn't perfect. And we've got over 41 years now of working in manufactured housing communities, and we really can understand the total cost. There are some things that we can't control that I think at this moment, where we're really going to have to adapt. You and I were talking about Helene and its impact earlier. Well, one of the issues that we sort of have, if there is a climate challenge, and a climate event, how are our borrowers resilient? Like, even if the residents own a cooperative, if you think about the people that we work with, the average income is about $30,000 or less in our resident communities. And if they own their homes outright, if they've been there for 30 years, they may not have property insurance. And if they have property insurance, is it enough? So I think one of the things that we're doing is that we've been hiring very aggressively. And how do we come up with a climate adaptation and mitigation strategy for the people living in these mobile home parks in New Hampshire? And right now we have more questions than answers.
Yeah, and it's you mentioned the Helene stuff. It's the folks who were living in mobile home parks in those flood zones are truly the ones who have been devastated the worst. Those are the folks that you see still the videos of that are still in campers and tents and all of that. I think a lot of times people might even look at that community and not see much empowerment or kind of not see a way forward. So I think there's something really beautiful about this originating amongst folks who really didn't have many resources but each other. Do you think that that has kind of contributed to the vision and the spirit of the loan fund and of the cooperative model throughout the years? How has that played out?
Yeah, yeah, absolutely. And I think it is. This is a weird analogy, so everyone's gonna have to cut me some slack. But if you think about how we're funded, and this is a question Joel will probably ask later, but most of our funding comes from individuals that we have. Somebody will lend us $20,000 and we'll pay them 3% interest and we'll re-lend it at 6% or 5.5% or whatever the resident community can afford. And if you think about it, the bicycle, if the rear wheel is our investors, the 628 individuals that sort of invest in the community loan fund, and the front wheel is mission, we really work together that if all you have was a rear wheel, just a bunch of investors with assets that were trying to solve problems, no matter how hard they pedaled, it wouldn't go anywhere if there wasn't a front wheel steering them. By the same token, us, we think of the community loan fund really as that front wheel driving it. If we didn't have the 628 individual investors, we really wouldn't go very far. We really need them. So in New Hampshire, the community loan fund really started because there were a group of people with resources that wanted to make the state better. And there are a bunch of people that needed resources that didn't know how to get access to them. And we really exist as a conduit between those with resources and those who need them, whether it's the Sisters of Mercy, whether it's an individual, who wants to put some money away for their grandchild's college education, or someone like me that just writes a check once a year for 0% and sort of invest because I really like living in New Hampshire, and that's really the conduit. And one of the things that our investors that we sort of noticed thinking about why our mortgage business has performed, one of the things that we sort of noticed is that people could have been a really good borrower, but they didn't have enough money for down payment and closing costs. So we went to our investors and said, we got a problem. We got a lot of people that would be really good home borrowers, but they can't come up with the skinny to do their fees. So we said, we created what's a homeowners assistance loan program. And I think this is pretty cool. If you are at 30% of area median income or lower, we'll make you a 0% loan for your down payment and your closing costs that sits silently until you sell your home. Meaning you don't make a payment on that 0% loan until you sell your house, whether that's 5 years down the road or 30 years down the road. Interest, since it's 0% interest, I can't say that interest accrues. It's the same principal balance. But we have found that that was really the difference between people getting in homes and people who couldn't. We tried something new this year where we said, if you'll buy an Energy Star home, we're going to make you a bigger homeowners assistance loan. So instead of lending you $25,000, maybe we'll make you a $35,000 homeowner assistance loan. And using that carrot has really gotten a lot of people into energy efficient, really good homes. Because in the past, if I say to you, hey, Joel, would you rather have an Energy Star home and Energy Star appliances or an extra bedroom? You'd probably say, I want the extra bedroom or the TV room or, something like that. So basically by increasing this homeowners assistance loan, we have our lowest income borrowers actually in our most energy efficient homes. And it's funny, It's actually been a little too successful because we sort of used up all our homeowners assistance loan money. So our philanthropy team is out raising another chunk so we can keep it going.
Man, now I'm thinking about what I want to use an extra room for. So I want to kick it over to Michael, though. I know we want to dig into some
Yeah.
details, and then we are going to get to audience participation questions. We love your all's questions. A lot of times, that's the best part of the whole show. So go ahead and type them in just into the general chat, and then we'll make sure to leave some time at the end where we can go through and get to as many of them as we can.
So one of the things that's great, Steve, about having you here is that many of the funds that we talk with are very small, very early stage, and you have been around for 40 years, and you can kind of see the future for many of the funds, many of the people here that have ambitions for creating funds. So how large are you right now, and how many investors have participated in your program in the 40 years?
Well, I can't answer that question. Right now, I think we have 628 active. Our loan portfolio right now of active loans in the book is about 205 million. We have about 240 million in assets as an organization. We've done over $1 billion in financing in our time. I think that the trick for us is, and everybody has a different strategy. I think for us to grow to the scale to solve the problems we want would require multiple generations. That we really try to leverage other people's balance sheets as much as we can. So we have a really good relationship with these, with the banks in our region. And we try to use their balance sheets as much as possible, doing subordinate debt. And for these resident-owned communities, we work with them every year. And what's sort of unique about us is the minute we close a loan is really the beginning of the relationship, not the end of the relationship. So we're able to get a lot of our banks to invest in these mobile home parks because we're there going to those membership meetings, doing a lot of board training. Because you can have a board that's terrific for 7 years, and then at year 8, they get a new board that's inexperienced. They want to hire their cousin to do the snow blowing and their sister to do the trash collection, nepotism. And, so the area banks really rely on us to keep these cooperatives, on the up and up. And I would say it's the worst business model you could ever imagine because all this coaching really doesn't pay for itself, but we've never had a co-op fail in 41 years.
So that's one of the things
That's
yeah,
really, and that's, it's market making. Like we have to
yeah.
prove, we won't let a co-op fail at this point because if we want to make sure that there's good public policy supporting the rights of residents to buy their parks, we have to prove that the model is really, really strong and resilient, and that people who otherwise can't qualify for a subprime car loan can execute a $20 million transaction and manage a large real estate corporation. We're working on a cooperative now. This will be the third time trying to organize. It's 147 homes, and it'll be a $19 million transaction. And if I think about, if I were to brag about us, I would say but the real brag is not about creating the idea of resident-owned communities. It was rejecting the received wisdom about what low-wealth people were capable of and what the value of manufactured housing was. That we didn't let the stigma. And I think if you think about housing policy in this country, it's largely created by people that haven't lived in multifamily housing or have not lived in a mobile home. And if you look at our board, we have people who live in these resident-owned communities on our board. So, you have people in these resident-owned communities, managing a relatively large financial organization. And I think that's really good at keeping us honest and transparent. If we loaded our board with a bunch of benevolent millionaires, I don't know if we would be as effective as having some of these members of these resident communities who sit on our credit committee and really sort of analyze and say, hey, this expense doesn't look right to me. I know this co-op, or I know this park. Let's look at this issue. I think that's been a really critical part to our success is that our board and our staff reflect the communities where we work.
So how big is the staff? And one of the things that I'm really interested in is even though you've got a $200+ million portfolio, you still are raising donations in order to pay for technical assistance. Like the economy of scale doesn't still quite cover the nut thoroughly, and I'm interested in your thinking about that.
Yeah, I mean, I think we think about how we want to do as much programmatic work as we can, and I want to make sure that our staff. I don't want to be doing low-income housing work if my staff can't afford to own a home themselves. And so we
The Henry
every non
Ford philosophy.
yeah every nonprofit has a different idea about compensation, and I want to make sure that people on my staff can make a career in community development finance. We invest a ton of money in training for in executive coaching. My hope is that we will not only be the parents of good loans and good homes and good rocks, but of good nonprofit leaders. That's a really important goal of ours as an organization. So we invest heavily in that. But we mainly raise donations for innovations. If you want to make a 0% loan that's going to sit silently on someone's books, that's that's really a non-accrual piece. One of the projects we're working on now is a domestic violence shelter came to us because they were running out of space. Well, the reason they're running out of space is that because domestic violence survivors couldn't afford to move out of the shelter. So we were like, well, yes, we can lend you $2 million to build another shelter, but why don't we try to lend money to the people to try to get out of the shelter instead? Whether it means first and last month's rent, whether it means we're getting a repair to a car, like how do we do that? And, that's not really a loan. We do it as a 1% loan, but we're never going to collect it if someone doesn't pay. But to me, that's something that requires philanthropy. To sort of help people, get independent. And really, there are really what are considered 3 stages to coming out of domestic violence. And for people that are in that 3rd stage where they're ready to launch into autonomous lives, that to me feels like something that requires philanthropy. If I'm taking an investment, from Joel, for example, that's something I would take this investment. I want to put it in a loan to a resident community that's paying 6% interest with a 30-year maturity or something like that, or a 40-year amortization. It sort of fits his investment better. But things like what we're doing with domestic violence survivors, or making 0% silent loans, that strikes me as a better function for philanthropy. I know you can think of all monies as fungible and in buckets, but I like to think that we really try to right-size different monies with different risk horizons. We have never not repaid an investor in our 41 years. So while we are lending to people that are obviously economically outside the mainstream, we got to pay Joel back. Like,
Right.
that's just, or, it really happened with the Sisters of Mercy. I remember Sister Corrine having this talk, she's like, invest the money wisely and pay us back. It's our retirement money. And she had another talk, but she did a teaching at my house last year. And she, so already a lot of my staff, and they're all very young. They weren't even born in the 1900s, if you can believe it. They were all sitting cross-legged in my living room. And she said, remember, young people, no margin, no mission.
That's great. Well, one more question and then we'll open it up for the group.
Sure.
And that is, we're in an era where where all government money has a cloud over it.
Yeah.
How are you thinking about your future if the spigots for CDFIs get shut off?
Yeah, it's the question you have to ask and that everybody's talking about right now. The vast majority of our money comes from private individuals and local people, not for the government. So I'd say for us, it's less germane than I think it is for other CDFIs. And some of this is just who we are philosophically. I mean, we really do think of ourselves as a region. You know, our goal is to connect everybody in our state who has resources, who wants to solve problems with people who need it. And, you know, it's that bicycle. So I think we're probably less susceptible to it. You know, the talk I have with some people on my staff this morning is, you know, who are we as an organization? We're in the solving economic disparities business. That's just who we are. Yeah. If a funding stream changes over time, but it doesn't mean like who we are changes. Like we've done what we've done for 41 years through 7 presidents, 8 if you count Trump twice. We'll be around for another 7 or 8 presidents. Solving economic disparities is what we do, and that pivots. Things pivot over time. You know, 20 years ago, if you were sitting on my chair, you would have said creating jobs was really important. Well, today, the most important issues in New Hampshire is how do school teachers, how do people work for the fire department, how do they afford to buy a home when the average cost of a home in New Hampshire is over $500,000? You know, and if you want teachers living in the communities where they're working, you know, that's really, really important. You want seniors. You know, one of the biggest questions I have is so many of my staff members have their aging, it's usually their aging mothers, living in manufactured housing co-ops right now because it's single level living. Homes are close to each other. You know, it's great. You know, a quarter of the people live in our rocks have a disability. You know, like these are essential functions. If how it gets funded changes from a federal program to philanthropy, that's a detail. It doesn't really change who we are and what we do. So I don't want to say that I'm not paying attention to a lot of what's going on in Washington. And I don't want to say it would be crass to call it noise.
Right.
But we
Well,
are, I know who we are and I know what we do. And I don't think that should be up for negotiation. But we're going to constantly evolve and pivot to the needs of the community and you know, what is the community problem that we're trying to solve? What's the economic disparity that we're trying to ameliorate? And then let's sort of back in and engineer the solution to it by what resources are available. And that's just what CDFIs and other community development lenders, you know, have been doing for decades. I don't think there's anything sui generis, you know, about us taking that approach. But I'd say we know who we are, and that's not up for negotiation. So I hope I'm not being glib to your question.
no, I think I'm inspired by that answer, and I think it's a good thing for all of us to keep in mind. Stay with mission, and times change, administrations change. It's dangerous, I think, to be too dependent on any one outside source, especially a CDFI source of money that's subject to the whims of national government. But it sounds like you're pretty well insulated. So, Joel, let's hand it over to the audience
Yeah,
and what
I
they're
kind of wanted
interested in.
to echo that too a little bit. You know, I think there's a lesson there that you've brought up a couple times, which is that because you guys have more agility, more flexibility, more resilience in the long run because you are funded and represented by the people who are real stakeholders in the project, who are members of that housing community, who are actually sitting on the board and who are the investors themselves. Because any fund or any pool of money, you know, the more it's going to take from something like private equity or the more it takes from a larger, powerful body, the more I think you kind of have to ask at some point, like, are we giving communities access to capital or are we giving capital access to communities? But, you know, your ability to have that from within, I think is an incredible risk mitigator and protection and resilience builder. And so I just, yeah, I just wanted to I think there's a huge lesson in there is the more local you can keep it, which is kind of the whole point of Main Street Journal, is like the more local you can keep it, the more control you really have inside your community and the less you give it away.
Thanks. No, thank you.
So we got a couple questions here. First, I wanted to see, Scott, you had a good one. Are you able to unmute, my man?
I am indeed.
Yeah, take it away.
Yeah, well, Michael Schumann, obviously it's good to see you, and this is a wonderful conversation and so important, especially where I live in the Midwest. We've got a lot of displaced communities that suffer these issues, but a lot of what we're talking about still involves first world capital. I mean, crowdfunding in itself requires US dollars in order to finance a lot of these, altruistic projects. What I've been doing in the side of working in the crowdfunding space for so long has been working in the pre-crowdfunding space and helping power communities in crisis with a currency, not the US dollar necessarily, but a local currency, a complementary currency. And I'm just wondering if this discussion has been had in your group or with others about, helping these families that are, facing a crisis of equity, buying their own, destiny and future in the houses. Is there a way that we could incorporate, or has it been discussed to incorporate a local currency in facilitating a local marketplace for exchange of goods and services, which oftentimes are kind of time banking style initiatives, but ours goes a lot further than that.
No, we have never discussed that here internally. And I think it's a fascinating topic. Can we get enough of it? Can we get enough scale? There are two organizations that exist in our state of people who live in these resident-owned communities. And could you mobilize those communities to keep money circular? Would be the opportunity.
Yeah.
But right now, we use these communities, these organizations of people who live in manufactured housing in the state to solve problems that aren't necessarily more prosaic, but they're certainly more urgent. There was a microburst in a community in western New Hampshire that devastated the park, and this was a strong co-op that had a ton of money in reserves. And well, they did over $300,000 of clearing of trees. Well, great. So they still had another 300,000 of tree clearing to go. What happened was, those other resident communities and other groups like the United Way in the western part of New Hampshire, led by Liz LaRoche, really came to bat. And we worked with our state's charitable foundation because FEMA didn't view this as a disaster.
Right. Too small.
But if you lost your home, there were a bunch of homes that were just uninhabitable, and there were people who didn't have property insurance. So we immediately needed to do action. There's a huge fight. I talked about the 60-day notice that Elliott Berry really championed 41 years ago. Well, private equity firms are spending as much money as they can to sort of get rid of this opportunity because the parks are obviously much more valuable as land to develop into single-family housing or to put up hotels.
Mm-hmm.
So we are really in a battle, to sort of protect the rights of people who work in the police department to be able to own a home and own the land under their home.
Mm-hmm.
So the questions that you're talking about, alternative currency, I'm like, wow, I want to get, it's funny because we're considered one of the bigger CDFIs in the country, and I want to be big enough and have enough capacity where we can take on issues like that. But right now, we're really focused on protecting the rights of residents to own their own homes, and then helping them figure out how, if or when a climate event happens, how are we going to help them weather that? So how do we build up the collective reserves of these 151 co-ops? And one of the big challenges is, for those of you that operate loan funds, every point that I charge an interest raises the lot rent for the residents in a co-op.
Right.
So literally last year, I made a loan at 5.15% to a cooperative. Well, what does it mean if my investors want to get paid 5% because they get 5% at a local bank? So we're constantly looking for ways to create revenue so we can buy down interest rates. If it's something like buying a mobile home, you can charge a higher interest rate. Like even if we charge 8.5% or 9%, if you were to do that in the market, it would be a 21% loan. The fact that we're willing to give someone a 30-year fixed rate loan on an $80,000 mortgage. Like think about our average mortgage to buy a home is $80,000 in New Hampshire.
Right.
You know,
Right.
so we have some of those opportunities. So what you're talking about is really exciting. But you, I think it was Michael asked about philanthropy and donations.
Yeah.
Like we sort of need that both to pay for the staff capacity to do that. But one of the biggest things that we sort of invest our staff time in is trying to do infrastructure improvements. That if you buy a park, landlords are much better at raising rents than they are at doing maintenance. So whenever residents buy a park, there's always something hiding. There's always $1 million in deferred maintenance. So we have a team that really works with these resident co-ops to work and apply for USDA grants to do infrastructure improvements. The stuff you're talking about, and it's really exciting to sort of imagine what the power of that. If you have 10, like we have almost 10,000 people living in our resident-owned communities. I don't know, is that for you, Scott?
Oh, it's
10,000 people enough to do a currency?
It is and it isn't. What you're talking about is kind of a vertical that we really don't explore in the nature of an economic development initiative of our scale is requires a certain diversity of goods and services be provided
Okay.
and a certain depth of redundancy in order to make a truly, functioning circular economy. So I understand your point. I guess one thing I would leave with you, and I don't want to cannibalize this conversation because I know there's other people with questions, but the one thing that I'm doing right now, and we're just about to launch this initiative, it's called the Sustainable Communities Framework. I left a link called weeconomy.us on the chat there for anyone else that wants to see what it's about. But the essence is we are de-risking first world capital investment, right? So we're de-risking a bank's position. We're de-risking an investor's position by carrying entrepreneurs or small ventures or small businesses up to a point at which typically they wouldn't have done all the homework in order to be a viable business. So we get them to the point of viability before we ask for a rich uncle or before we ask for an equity investor. In that way, I think we've taken a lot, of the risk off the table for these later stage investors. And that's an area that I would want to explore with you. We can certainly talk about it offline, Steve.
No, thank you.
Well, and Scott, I would encourage you, solving that friends and family gap for the type of folks that don't have friends and family, and kind of solving that funding round is something that is a topic of discussion amongst the neighborhood economics conference. So if you're keyed into that, you might want to check that out. I think that there's going to be some discussion
The
about
way
that.
we view that, I'll
Yeah.
just put a plug here because I think it's one of the things CDFIs don't do well, is that we're not talking about the permanent working capital gap. That, for a lot of small businesses, that they don't have enough permanent working capital, and so their balance sheets are always over leveraged, or they're using today's money to pay yesterday's bills, when they need to get a new refrigerator. So I think the stuff Scott is talking about is an interesting way of what I think is to solve an endemic problem for some of these small businesses.
Well, I'll give you one
I
more
think our
example.
industry is silent on. Yeah.
This is a really quick one, but the first stage that I use to explain, because people have a hard time. Most Americans aren't educated on what money is or where it comes from. And so to have this discussion with them, the first question is, yeah, well, great, alternative currency. Where am I going to spend that? And that's a legitimate question. And obviously we can get into answering that further. But the first installation that we really say, this is community capital getting together to solve community problems, is community gardens. We have a lot of blighted homes in the Rust Belt. And just to tear down a blighted home between two good homes raises their property values, and it makes the whole community more investable by, first world capital when it's time for that. But in the meantime, community gardens, as we've seen in Detroit and Cleveland, are cohesive. They breed the type of community that we used to thrive on when we had a better bridge to the agrarian culture that we came from. And I think that provides, cost efficient, even affordable, even free produce, which is critical to nourish the minds of the next crop of job creators that we need. So that's one of the big ones that we really tackle, community garden. Yeah,
that's awesome, Scott.
Thank you.
My first venture into all this world was actually working with a community garden nonprofit in Ypsilanti.
All right.
Yeah, so right by Detroit there. So
Just
yeah,
had a
love to hear
meeting
it.
with Angela Barbash yesterday, who runs a little a place called Revalue out of Ypsilanti. Well, she used to.
I met with her yesterday too. She's a good friend of mine. Yeah,
What are
that's
the
great.
odds, dude? We're in the same place.
Yeah.
Good. All right.
I want to kick over to also let me see. We had Roy. Roy, are you able to unmute here?
Yes. Hi.
Hey.
So Michael's aware of what I'm trying to do because I met him about 2 years ago when he did a crowdfunding seminar for a small chamber of commerce in our area. And but I have a nonprofit, and I've been exploring the media space. Independent local newspapers who are struggling with succession. But just like with cooperatives, a cooperative model is not a solution for something that's losing money. It has to be a solution for something that at least is breaking even. So I located a 60-year-old legacy newspaper business that the owner's retiring, and he likes the thinking, going back to the why and the mission. He likes the thinking of what I'm doing. And we're taking an existing media company and then fusing it with sort of like a movie studio talent agency. And so that long term, we can actually create content that can be syndicated and licensed to create revenue. So we're not just dependent on solely on advertising. But this entity, this fellow is willing to donate the newspaper to our nonprofit. There's some tax benefits for him. It's been independently appraised for over $800,000, but we can't do crowdfunding after we close on the deal. So I've been looking for a small working capital loan, and I thought, well, I can go to a local bank or a local CDFI because it's the only debt. It would be $50,000, loan to value on something that's worth $800,000. Even if it's only worth half that, it's still a low loan to value. That would allow us, because once we close on it, we still have to pay office deposits and utility deposits, those kinds of things. Okay. But I can't seem to get anybody to bite. Now I have someone, an impact investor that has a small fund, and that person said to me, can you get a small loan if you have a third party guarantor? So I even have a guarantor in sort of in the queue. But I can't seem to get a local group to pull the trigger on providing us with a small working capital loan. So I'm open to ideas because I'm getting flustered.
No, I mean, this conversation is one I hear a lot from public radio stations that are looking to diversify their income streams and trying to figure out how to be sustainable. And so it's a big issue out there. It might be worth, I think having a guarantor should make a CDFI want to make this loan in your region, but it also might be worth a conversation with CCA Global and the great Howard Brodsky. I mean, Howard, in terms of business co-ops, I mean, he's probably the smartest guy I know in that space. And Howard is notorious for looking at, as you would say, businesses losing money and figuring out how to put 10,000 of them together to make them make money. I think Howard stitched together over 10,000 childcare centers in the United States working together in a co-op.
Well, this business is actually making money.
Okay, yeah, but I mean, being
so it's a good model for us to take over, and it's making money, and anything that we do, we can just add to it because, as you well know, once you break even, every incremental dollar you take in, a lot more drops to the bottom line because you're already paying your basic bills. So this particular one's already making money. So we're just trying to get the closing done, and I can do it if I really, turn the screws on it for even $25,000, but because I got to have some to again pay these deposits.
Yeah.
When you take over a business, you got to turn over the utilities and make a deposit on the rent, those kinds of things. So
I wonder
it's
if
not
you're
a lot of
charitable. There are two other suggestions I'll give you. One is that most charitable foundations I know that have really built their assets over the last 5 years have their own impact funds, and they might be willing to do something out of that corpus. The other group I would try is your business finance authority in your state. I would approach them. That strikes me as a potential investor. They're a quasi-public entity, but business finance authorities, these are the sort of things they want to see stay alive.
Sure. So could you give me the name again of Howard, his full name?
Howard Brodsky, Brodsky, and it's CCA Global.
Okay.
But I think your charitable foundation making an impact loan that sounds like something they would want to do, and Also, your business finance authority was someone else that I would talk to. And I'm thinking, just because I've seen a business finance authority make a loan to a newspaper that I know that was, where it needed new ownership, when people were aging out. So I
Yeah,
don't think that's out of the question.
our long-term goal is to convert it to a community ownership model, which would be part owned by the community and part owned. So sort of like a multi-stakeholder cooperative, which I'm very
Yeah.
familiar with that model.
Very,
But so I know what we can do, for lack of a better term. But getting to that possession, I just thought it would be easier if we went to there's a social impact fund in our area, and they said, well, it's really not, we're not interested in the newspaper business because, print media is dying. Well, that's like saying a mobile house is not a real home. That it's a consciousness that is just ridiculous. Media is a component of communications, So anyway,
I say this as someone who only reads paper.
Yeah, I know. So anyway, thank you, and I appreciate your input.
Thank you.
Yeah, thanks, Roy. We got two more here. One was from, I hope I'm saying your name right, Neural, is that right? You had a question regarding approaches here to I want to make sure I understand what you're asking. Are you able to unmute? 4, 3, 2, 1. No, we'll go down to Martha, and if we need to come back, we can come back. Martha, sounds like her and her church are starting a fund, and they want a little guidance here.
Yes, we're total novices, but our pastor and her husband had this long-term dream for exactly what you're talking about, an ROC. And they found a piece of property that's about 53,000, and we've been in this North Carolina Rural Center Connect program for a couple of years, where they were offering $50,000 for us to come up with whatever project we wanted. So we decided that we would like to try a low interest revolving loan fund. So right now we have the one project and the one loan, and I can already see that, so we're talking about 1%. We know the people, we know it's gonna go well. But I can already see that, in order for us to keep this going, it's gonna take something more than that. Our local bank that we spoke with does not yet offer a CDFI, and they said it's gonna be years. So do we need to have some kind of legal structure? I mean, what kind of issues do we need to be on the lookout for?
I'm going to put my my contact here. We should talk offline and connect you with our finance team.
Okay.
And you're in North Carolina?
Yes.
Yeah, and I mean, I think you should also. I'm a homer for this because I spent 13 years at the Self-Help Credit Union.
Yeah,
and,
great people.
which is the largest CDFI in the country, I think, or if not the largest, one of the largest. And this is something that they would probably want to help in some way, shape or fashion. But if you'll contact me offline, I'm going to put you together with our finance team, and we'll just sort of, we'll give you some guidance. Self-Help once a year does something called the Shaw Institute, named after Bob Shaw, where that's basically they bring in a lot of people who want to start loan funds and sort of do a 1-week boot camp on how to do everything. And
Okay.
that might also be of interest. And Neil Goslin is the person who sort of runs that. And I'm just going to go over to well, actually, I'm not going to do that because I'm on a webinar. When you contact me, I'll try to connect you with Neil, because it'd be great if you could go to the Shaw Institute. Since you're in North Carolina, you can just drive over there, and they can be of a great service to you. And Self-Help's just a wonderful organ, different than us. They're a credit union, and but I have great love and respect for that organization.
Okay, so you don't actually who actually manages your loans?
We do.
Okay, but
Yeah,
you
and we'll
banks.
teach. Yeah, we'll I mean, I think I don't want to eat up the whole webinar. We're happy to walk you through how we do it.
Okay.
And it's, I think commercial loans, a lot of it depends on the size of your portfolio, how many loans you're monitoring and whatnot. I mean,
Yeah.
we started with one $42,000 loan. and now it's grown into over $1 billion out, and got 200 million sitting on the books. And, it's starting with a good loan is a good way to do it, and
Yeah.
it's just figuring out the economics of it.
Right.
But it's also you do not have to be a CDFI to be an effective loan fund. And I think, you look at what Rudolf Steiner's organization, RSF Social Finance, has grown into, is a great demonstration of a non-CDFI success story. I'd say that if you get me to go on a rant about things that I think about, I think we started this conversation with Joel prompting this, and I sort of left it alone. To take risk, you need a bit of scale. If you are a very small loan fund and you make a big loan and it goes sideways, it takes down your whole loan fund and it takes out those investors.
Mhm.
You really need to be, big enough that you can have a loan go bad. Like we have two sort of missions. We're trying to ameliorate economic disparities, but we're also in the risk business. We're trying to take the risk that a bank can't because of OCC regs, or a credit union can't because of NCUA regs. So we have to take risk, which means that if I don't have a loan go bad, it means at some point I'm actually failing our investors who are expecting us to take risk. But I also have to pay, like Anna Berry, my teammate who's sitting next to me. She's got twins. She's got a husband. Like, she's got to pay her mortgage. Like, I have to be able to pay her salary. I've got to pay Joel back as our investor. So we need to have enough scale that we can take risk.
Yeah.
And I think when you have a small loan fund, how do you take risk? Do you do things, Scott sort of introduced this question. Do you find a way of de-risking other people's capital? Like, instead of you making the loan, do you use your money as a guarantee or a credit enhancement to unlock other capital? And I think those are really interesting conversations. And then, like, your 1% fee that you charge could be a 1% guarantee fee instead of 1% loan fee. I mean, there's a lot of creative stuff, and this is the point where people on my staff are like, oh boy, Steve's getting going. Look out, because I think this is the really exciting community development things where we start thinking about how to unlock more capital. Because my goal is not to have our organization be a $5 billion community loan fund organization. I want to be that really important lender that can move tens of billions of dollars around me and other people's balance sheets, because we're really experts at solving problems. So we want to leverage up our capital as opposed to using our capital as an end all and be all. So I'd say there's very little that we do where we walk alone. When we go into projects, we try to walk with as many people as possible to build the ecosystem of capital possible. And sometimes that involves government entities like our business finance authorities. Sometimes it involves private banks, and sometimes charitable foundations. So when we do loans, I mean, that capital stack is multi-layered, because I want to be as sparing with our capital as possible to stretch it as far as possible. Because if we invest in something, other people assume it's good, and they assume that we're always going to make sure that we make them whole. So that is kind of the unspoken ethos in the organization: is make sure every investor that comes with us is treated well. Every borrower is treated super well. We built the ecosystem. We're not going to, things do fail because, you're in school and you went to school with people who didn't do their homework, no matter how hard the teacher tried. That you have loans go sideways, especially trucking businesses. But that's a sort of bad lender joke. So I would think about, how do you leverage up your capital as opposed to trying to be as opposed to a standalone? And I think that that's a really exciting conversation.
Yeah. Well, thank you. So what I'm going to do is when I get the recording of this, I'm going to forward it to the other team members, and your information, your contact information, and I'll try to get together with the other team members, so that we could all, like several of us, could it's a very small group.
No problem. I love it. I love talking to other. I grew up in Durham, so I'm always down for talking with other North Carolinians.
Yeah, we're
Oh, yeah.
between Boone and West Jefferson. So Joel, I can relate to the Helene stuff.
Oh, yeah. Yeah, you
Yeah.
guys got hit there too.
Yeah.
We have to wrap it up here. Thank you guys so much for joining. There will be archives of this on the Main Street Journal right now. We are working on an archive database of this for Impact Alpha as well in the future. And check out the New Hampshire Loan Fund if you have not already clicked on that. And join us next time, 2 weeks from now. We'll be talking with another fund. Jen, who do we have coming
Yeah,
up
we
next?
have Matt Kropp of Vermont Real Estate Cooperative on March 12th at 2 o'clock. And then after that, we have Leslie Watson of Northeast Investment Cooperative on the 26th of March. So co-ops.
That's right. We're making a tour of the New England co-ops here over this spring. I love it. All right, you all have a good one. Take care of yourselves. Until next time, remember
Thank you,
we are each
Steve.
other.
Thanks
Thank
all.
you.
Thank you, Michael.
Thank you,
Thank
Steve.
you. Thanks, everyone.
Bye now.
Very much.
Okay. Bye-bye
Bye.
all.